The Federation of European Exchanges represents exchanges at the European level. We have more or less 40 members which trade shares, derivative bonds, but also commodities, and in fact approximately 10 of our exchanges are in the commodity business. And since I was sort of dumped last minute into this panel, and I'm no specialist, I thought it was safer maybe to give a presentation and then to shut up for the rest of the panel, which is what I'm going to do. And in fact, this presentation I quickly put together thanks to Raphael, who's sitting here, my colleague, talking to the CEOs of our exchanges. And usually commodity exchanges are very frustrated because they feel that nobody understands them, okay? And then there is a lot of copy-paste of what is happening in the equity markets and sort of being put into the context of commodity markets. And that's frustrating because commodities are different. And I think we're going to hear about this today. The most important question in the commodity market is, what is it worth? What is it worth helps a car builder decide whether or not he's going to buy aluminium in 10 months or not. It's going to protect him from the risk of price fluctuation. And this is already the second very important aspect of commodity markets. In fact, you probably know, for those that are in the commodity business, this is going to be boring, but for those that have never heard about them, commodities were actually invented in the US, in Chicago, and it was basically initially a way for farmers to guarantee their crops against the fluctuation of prices. If you plant today, you want to be able to sell that crop at a particular time when the crop comes to the market. And today, these markets have become investment opportunities, and I think a lot of the debate today will turn around this new development. Commodity markets 10 years ago were backwaters, okay? You would typically find them on the last page of the Financial Times. That's just how sexy they were. And in the meantime, a lot of things have happened. And I thought that maybe before we start the debate, let's look at the families. In fact, we have three families here that are actually important. First, we have the softs. And you will see on the first picture, I hope for those that are in the back of the room can still see them, and especially those that are hidden behind the cameras in the column. Coffee, cocoa, sugar, wheat, rapeseed, and corn are soft. So this is the agricultural family. We have the energy family, where we have electricity, oil, natural gas, and coal. And then last but not least, we have the metal family, which has aluminium, copper, lead, nickel, tin, and so on. And all of these products today are traded on exchanges. Now, in the paragraph introducing the panel, there's a sentence saying there has been a 30-fold increase in the trading. I think we're going to discuss this later on, but the first question, of course, is why? And talking to the CEOs of my exchanges, they told me, as Clinton would, it's the economy, stupid. Why? It's because price, fundamental, drive these markets. Now, they're all different, okay? So if you look at the soft markets, what makes the prices of agriculture fundamentally vary? Well, of course, the weather. But in Europe also, what you have seen is the deregulation and to some extent the agricultural common policy, which has changed and which has now made farmers much more aware that they need to protect against the variation of prices. So fundamentals drive the prices in soft, but fundamentals will also drive, and you've probably followed the debate in Europe about biofuels taking up more land, driving up energy prices. So again, here is a fundamental element which will have an impact on prices. In metals as well, of course, and there you will have probably followed, if you're looking a bit at metal prices, that the growth in China has had a substantial impact, for instance, on the copper price. The ton of copper has gone up from $2,000 5 years ago to $8,000, okay? That's China. At the same time, for instance, aluminium, you might have seen 2 days in the Financial Times, prices were down. Why? Because aluminium is being produced in China and hence the demand is much weaker. But what is actually new? What is new in this market is that you have now new investors. These investors are interested in being exposed to the risk of commodity prices. Why is that? It's because if you are a pension fund today, and you have a lot of money and you have to guarantee return. One way of doing this is to pack the value of that money to the rise in commodity prices. Now, just 2 words about what the Commission is trying to do to make sure that our markets are safer, and I'm not sure, can you maybe go forward with the slide? Thank you. What is happening today in terms of making this market safe? Well, one important element is you want to manage the quantity that you have in the market. Why is that? Because commodities, contrary to other derivative products, are finite. You only have so much gas. You only have so much coal. In financial derivatives, you can always invent new derivatives, okay? So here you have a finite volume, and hence, at the end of the contract, when the gas needs to be delivered, when the coal is coming in on a barge to Rotterdam, when the grain is being stored in a warehouse in London, you need to make sure that there is no squeeze. So a lot of the risk management in commodities market is different because you have to look at the physical delivery. And here actually the debate today is, should it be the exchange who is going to manage this throughout the delivery, from the initial contract to the delivery date, or, next slide, are we going to use US-style position limits? So, or whether are we going to use position limits as made in the US, where actually the regulator sets a set amount, which is not an amount that can vary. And I think we will have maybe an interesting discussion on that later on. Position limits are good. They can combat market manipulation. They protect the delivery at the end of the contract. But there are some things that they can't do. So there are limits to position limits. One is they cannot stop systemic risk. The second is they cannot stop volatility. On the contrary, you have seen that, for instance, in the US onion market, where no swaps were allowed anymore, the volatility increased. So position limits will not stop volatility, and last but not least, they cannot really impact prices. So there are limits to position limits, and I think we'll discuss this a bit later as well. Thank you very much.